Joining us to discuss the financial crisis facing Europe and how it might affect our own stalled recovery in the U.S. is Simon Johnson. He's a former chief economist at the International Monetary Fund and a professor at Sloan School of Management at MIT. Simon, thanks for joining us.
Thanks for having me.
You know, I feel like I was having this conversation a year ago. Greece was heavily in debt. The International Monetary Fund and Europe provided funds for Greece so that it could have a year to get its financial matters in order. So why didn't that happen over the past year?
Well, Greece is in a very big hole. It has a lot of debt, a lot of government debt that's been accumulated over many years, and it's not that easy to get out from under this kind of debt burden, particularly when you don't have an economy that can turn around and start to grow rapidly.
Well, let's talk about how Greece got there. They joined the EU and then they switched to the euro in 2001. And then shortly after that, went on a bit of a spending spree, making Athens look gorgeous for the Olympics, while there was widespread tax evasion. Should Greece have been allowed to switch to the euro? With hindsight, should they have been allowed to switch to the euro or even join the EU?
Well, there are obviously many people in Europe right now who are asking whether it was right to let Greece into the euro. But there were rules drawn up about who could get in and on what basis, and Greece complied with those rules, or at least it appeared to comply. In retrospect, it turns out that some big global investment banks helped them massage their numbers so that they could meet the criteria for joining the euro.
Let's get a little bit of a historical check here. This idea of the Eurozone, Europe as unified, started after World War II. Give us a little bit of history lesson there and explain how that's affecting what's going on today.
Well, the European Union was founded on the very understandable desire to avoid having another major war in Europe. Initially, it was an agreement between France and Germany. It made sense to involve Italy as the third largest economy, and other countries were joined in what was then called a common market that was about reducing trade barriers, increasing the amount of transactions and the movement of goods and people across these various countries. Very sensible, very successful, helped them grow, but then they decided they needed to get closer together. They need to make it more about financial transactions becoming easier, and ultimately they needed to have a common currency. That's the euro. The euro was introduced in the late 1990s, and its history to date has, as we see now, been mixed. There was an initial surge of enthusiasm. Many Europeans are very proud of the euro, but now we have serious problems, not just in Greece, also in Ireland, also in Portugal, perhaps in Spain, and now the topic of this week is looming problems in Italy.
It was interesting. I read one blog post and the title was, "Greece Blackmails Europe." Why is there such a strong feeling about Greece's actions?
Well, emotions are very high on both sides, I would emphasize. The Greeks do not feel at all happy about their current situation and about the measures that they're going to have to take one way or another. On the European side, there is fear that a Greek default, meaning if they refuse to pay some or all of their debt, they'll be in default, that this would have a big impact on other European countries and on European banks, very much like the impact we saw in the United States and around the world after the collapse of Lehman Brothers and the failure or near failure of AIG in September 2008.
One of the things about the collapse of Lehman that we now know through various reports is how it was so imminent that there was a crisis, that there were meetings in the middle of the night with the heads of Morgan Stanley and Jamie Dimon from Chase. Is Greece, the situation in Greece, that dire?
Yes, I think it's that dire and perhaps even worse. The big US financial firms were, of course, what we now call too big to fail. The problem with Greece is that while you may feel Greece is too big to fail, take Greece together with Ireland, Portugal, Spain, and Italy, that group of countries collectively is too big to save. The Europeans can't save them, the IMF doesn't have enough money to save them, the US doesn't actually have enough money to save that group of countries if they're all going down together. So, too big to save turns out to be, I think, more damaging to the world economy than too big to fail.
One place where American investors are vulnerable to this, what's going on in Europe and in Greece, are money market funds. Can you explain why?
Well, the available data suggests that US money market funds hold a great deal of debt issued by European banks and European governments. Now, if this debt were held in equity funds, funds that could go up and down in value, well, it could be a problem. We could certainly have disappointing results this year, but that would not be quite so worrying. The problem is that many of the funds that hold this European debt are literally money market funds, and they've assured their investors, sometimes implicitly, there's certainly no legal guarantee behind this, but they've assured them that their money is safe, that they'll definitely get their initial dollars back, and they'll get some interest on top of it. So many people, American households, think of these investments as being just like a bank deposit. But it's not a bank deposit. It's not federally guaranteed. Well, it's not normally federally guaranteed, but of course, in the fall of 2008, the US government had to extend guarantees to exactly these kinds of money market funds because so many investors were pulling out their money after the collapse of Lehman.
So Simon, should people who have money in money market funds, I know I do, should we be concerned? And are there other effects from what's going on in Europe and Greece that America will feel?
I think people who have money market funds should check carefully what those funds hold. There are funds, for example, that are entirely invested in US Treasury securities, and I think those are completely safe at this time, despite some of the rhetoric coming from Capitol Hill. Other money market funds, to be sure, are more exposed to European risks. And with regard to the impact on our broader economy, there's no question that what's happening in Europe right now will not help the recovery. This will mean that it's harder for us to export to Europe. It could mean that the euro currency will depreciate, will fall in value relative to the US dollar, and that will also make it harder for us to export our way back to full employment.
There have been so many discussions about what should happen. Should Greece default on the loan? Should they be propped up by Europe? Should they devalue their currency and go back to the drachma? Do any of these make sense to you?
Well, I think at this moment, it's very hard to find realistic options for the Greeks. And certainly there are no safe ways out and there are no low-cost ways out. It's a great tragedy for the Greek people, a tragedy brought on by their own political elite, to be sure, facilitated by big international banks that were willing to lend them far too much money at very low interest rates. And the entire thing was made possible by the leadership of the Eurozone that put in place these very fragile and dangerous structures.
The new head of the IMF, Christine Lagarde, as soon as she was appointed to the office, she had a very tough line about Greece, a very hard line about Greece. She takes over on July 5th. How much will she affect what happens to Greece?
I think Christine Lagarde will play a very important role in the months ahead. She is currently French finance minister. The French are very worried about their own banks. Their banks do not have a good balance sheet. They're not able to withstand the kinds of losses that would result from a Greek default. And Madame Lagarde's policy so far has been to try, above all, and protect French creditors to Greece. Now, we'll see going forward the extent to which she's able to do that and the extent to which the Germans in particular will agree to use taxpayer money, their taxpayer money, to protect their banks and the French banks. And we'll see to what extent Madame Lagarde can persuade other countries represented in the IMF, including, for example, the United States. We have a 17% stake in the IMF, so any loan made by the IMF has 17% of our money behind it. We'll see to what extent Madame Lagarde can persuade the administration and Congress, including the Republicans in the House of Representatives, to what extent can she persuade them to use US taxpayer money to bail out French banks that made really bad, stupid loans to the Greek government?
That's not a compelling argument.
I think Madame Lagarde is going to have some trouble persuading the US to contribute the kinds of money that will be needed to really do another round of comprehensive bailouts.
Is there any lesson for the United States in all of this? There
are many lessons, and in fact there are many lessons from the fall of 2008 that we haven't heeded, and they're reinforced by this experience. The most important point is you need to make sure that your banks are rock solid. They need to have a lot more equity financing. We allow our banks to operate with about 3% equity compared to their total assets. Now, the official numbers, the official ratios that you see discussed in the press are different, but that's because they use a rather crazy system, so-called risk weighting, which means you don't have to have a lot of equity financing, a lot of loss-absorbing buffers if you hold something that's considered safe. Well, what's considered safe by international bank regulators? Greek debt, European debt, Italian debt has all been considered an almost completely riskless asset. So our banks, as well as other big international banks, simply cannot absorb the kinds of losses that are headed our way. We need to raise a lot more capital to our banks, for our banks, in our banks, and we need to prevent them from collapsing when these European events play themselves out.
Simon Johnson, we thank you for your time today.
Thank you.